Mr. Silva, welcome to the program.
Pleasure to be here.
What's your take on the price of gold? It has moved to $2,100 range today, pushing higher into all-time high territory.
Yeah, great day to be here to talk about gold setting all-time highs. Certainly there's a lot of research going out today talking about technical analysis and where things might go if it settles above 2,100. Some are calling for 2,300 as kind of the midterm reset in terms of gold. I think what's more important, at least for investors, is more what happens to equities, because we've seen gold be very resilient facing some of the headwinds of higher interest rates and a strong overall market. But I think this type of a move, if it's sustainable, and certainly if it hits closer to 2,300, you could see a significant re-rate in gold stocks, which have really been beaten up over the last 12 to 18 months. So I think this is kind of the shot in the arm you might need finally to see these gold stocks.
Aren't they on some occasions beaten up for good reason when they make stumbles from quarter to quarter?
Yeah, I can't say their track record has been spectacular over the last 12 to 18 months. We've seen inflation hit costs. You've seen both on the CapEx as well as the operating cost side. So there is some justification for it, but I think we're seeing in 24 and 25 a slowdown in that cost inflation. I think for 25, if you look at sectors, the gold sector as well as the mining space in general has some of the best earnings growth, I would say even competitive with tech stocks.
And what about energy markets? We've had the big players in Canada's energy sector report results through the end of last week. Canadian Natural Resources had a very, very good week. It posted gains on all 5 trading days, including 8% on Thursday and 3% plus on Friday.
Yeah, I mean, they've been shooting the lights out, whether it was CNQ or Cenovus prior to that. We've been very bullish on energy stocks, especially looking at this as opportunistic when we saw kind of this lull as oil kind of fell below $75 and even $70. For us, that was an opportunity to pick up some very high quality names like a CNQ or a Cenovus, and some of the names we'll talk about later in the show, which in particular give you good leverage to what we think will be an improving Canadian Select differential that's coming in the second half of this year as Trans Mountain kicks into full gear in the second quarter.
The latest news on the Trans Mountain pipeline expansion was another cost overrun, but you are nonetheless confident that when it arrives, and it's supposed to arrive in the first half of this year, that is when shipping actually begins on the pipeline, that we will see a narrowing of that differential, eh?
Yeah, because in MEG Energy's conference call for Q4, they mentioned, I think it was at the end of February, there was a call from Trans Mountain for 2.1 million barrels in April and another 2.1 million barrels for May. I think that shows a high level of confidence that they're going to be on track for a start sometime in May or even in June. And that will lead to at least what we think is a $4 improvement in differentials into something that is more, historically common with respect to the differential.
Why would it not be priced in at this point?
I think part of it is people wonder, is it on time? There's always some skepticism. We have seen increased competition in part from South America on the call of the U.S., looking for more from places like Venezuela, which is heavy oil. But I think at the end of the day, people do have a preference, whether it's in the U.S. for ultimate markets or China for, if you're going to look at heavy oil, places like Canada to supply that.
Let's begin putting questions to Dennis De Silva on resource stocks. Melissa has written us an email. Her subject line is Generation Mining. That's ticker symbol GENM on the Toronto Stock Exchange. I would like to know Dennis's thoughts on Generation Mining.
Yeah, Generation is a palladium copper producer in northwestern, or developer, I should say, in northwestern Ontario. I'm sure they wish they were producing already. This is, one of those that gets caught in the classic conundrum of, a project that I would argue the project is a little bit skinny on internal rates of return. I think the last number was just under 30% when they updated their feasibility study in 2023. It's about $1 billion, $1.2 billion CapEx, and it incorporates a lot of the inflation over the last couple of years since their last feasibility study. The difficulty here and why we only own it in some of our specialty flow-through funds is the fact that this is going to be a hard one to finance. I know they reached a deal with Export Development Canada and a few others on the debt side. The problem will be the equity. And, as much as I like what gold is doing today, that doesn't help a palladium copper producer or developer, I should say. So I think the crux here is, can they get financed on the equity side? I think the debt will come into place. It's going to be the equity.
Thanks, Melissa, for that question. Let's stick with the email inbox. Benoit has also written us an email. The subject is Osisko Gold Royalties, ticker symbol OR on the TSX. I would like to have Dennis's opinion on Osisko Gold Royalties.
Osisko Gold Royalties, I think the issue, and they have a new CEO, and I think he's cleaning house. The issue is always they have kind of this dual mandate of being not only a royalty company, but also owning pieces of junior companies, some of them which are related to Osisko, the group in general, like Osisko Mining or Osisko Development Corp. They have finally extricated themselves from Osisko Mining through a secondary offering recently. I think they still own 40%, if it is correct, of Osisko Development. The plan would be obviously to sell that down to zero and try to become a pure royalty company. I think that's always been the desire for the market is, if I want to compare you to one we're going to talk about, Franco-Nevada or Wheaton Precious Metals, something like that, you need to be pure. They have a great development pipeline, and they do have peer-leading growth on a gold equivalent basis. Very well financed, strong balance sheet. It's really about becoming a pure play and getting themselves out of some of these small tier companies that they've owned for years.
Okay, thanks for that question. Let's go to the phones for the first time in the program. Elliot is in Hamilton. Hi, Elliot.
Good afternoon, gentlemen. FNV, having unfortunately demonstrated weak risk assessment and poor portfolio management, 18% in one position, that's not advisable, as we now see. Please, what is your assessment of Franco-Nevada and its weak management team? And, Mr. Bagnall, when do they report their quarter? Thank you.
I'll get you that. Is he referring to First Quantum Minerals when he refers to that large position?
Correct. Okay. He's obviously referring to Cobre Panama, which has been recently put in care and maintenance as Franco or First Quantum negotiates with the Panama government. You're right. I would rather not see the company have such a large position in any project. I don't care how good it is. It's no different than our end of the street. On the buy side, we like a well-diversified portfolio. You'd never see 18% in any one company, no matter how much we like it. And I think when you have a company this well diversified with this many hands in the cookie jar, you figure they would be better diversified for this exact reason. Sometimes it really works well, and Cobre Panama is a first-class copper project, but it always had a bit of that geopolitical risk, and I think that's starting to reflect in the company. Now, that being said, I think the attractiveness of a royalty streaming company like Franco-Nevada shows in its performance. I think year-to-date it is marginally down, and that's compared to senior E&P companies that would be down probably 5 to 7% worse than what Franco-Nevada is doing. So despite Cobre Panama, it still has been a relatively better performer than E&P companies, and that's because people buy something like Franco or Wheaton Precious or Osisko Gold Royalties because they don't have that operational level of risk on a direct basis. It is indirect, like we've seen with Cobre Panama, but I have no doubt something will be worked out there. The fact that First Quantum was able to refinance its 2025 notes, raise a big chunk, I think it was $1 billion of equity that we participated in, that has given them the financial wherewithal to be able to negotiate with the Panama government from a better footing than where they were when they first shut down the mine.
Okay, and the company's reporting results tomorrow, Dennis. I haven't been able to pin down the AGM date just yet, but keep watching the program. I'm going to find it, and we'll announce it through the course of this program, the AGM date for Franco-Nevada. Elliot in Hamilton was interested. Now we go to Dennis. Dennis is in Burlington, Ontario. Hi, Dennis.
Hi, Paul. Great show as always, so far anyways. I can't wait to get these resource stocks coming up every once in a while. Anyways, my question is on West Red Lake Gold and Frank Justra being my best bet of all. I would like your thoughts on it. Thank you.
Well, thanks for the question, Dennis. Yeah, so we're talking about a small cap developer here, basically trying to bring back into production a mine that was shut down. Basically, the company went bankrupt. You know, I won't go through the details. There were a lot of mistakes done with the mine in terms of rushing it, not properly capitalized. The common story with a lot of juniors who are building a new mine, and that's why it's often better to leave it with the big guys. You're right, Frank Giustra. This was kind of his comeback story with respect to returning to the junior gold space with his initial investment, and he's made subsequent further investments in the company. We own it in one of our specialty funds at one of our flow-through limited partnerships, which gave us a tax advantage for our clients. It is a small cap, that's why it made sense in that fund. We continue to hold it. We do like the idea of recapitalizing the mine, working out some of the geological things that went wrong with respect to how the predecessor approach this project. And I think with the types of people who are involved with this, it's not just Frank, there are others. I think there's certainly good access to capital. It's one of those rare stories where I think they can restart this mine and do it more profitably than their predecessor. And it certainly helps that you have $2,100 gold at this point.
Okay, thank you, Dennis, for your question on West Red Lake Gold. Let's go to Tom. Tom is in Victoria, BC. Hi, Tom.
I recently discovered Tidewater Midstream, so I've been keeping a close eye on it. And looking at it against its peers, I can't understand why it is so cheaply priced here, just over 80 cents, I believe, today. Just wondering if I'm missing something, or if it's a screening buy here, as it has no debt now, as I saw that they recently sold a part of their business for over $660 million, and the market cap, I believe, is around $350 million. So something's not adding up to me. I'm just wondering what your thoughts are on this one. Thanks.
Yeah, thanks, Tom. We are a current shareholder of Tidewater. Funny enough, the CEO departed without much fanfare. Actually, an ex-partner of Middlefield's way back when was running it. I think the turmoil with this one is people are concerned about whether their renewable diesel facility is running well or not. It is the key for this company. They did sell their gas pipeline to AltaGas, as you said, for just over $600 million, made it debt-free. But in terms of what is going to be the earnings profile of this company, it really is dependent on whether this very important diesel facility is going to work on time and on budget and on operating costs. So I think everybody's kind of on pins and needles, including ourselves, to wait and see what happens. It doesn't give you confidence when a CEO departs suddenly. He had been an interim CEO, then made a full-time CEO not too long ago. And so when you leave under these circumstances, you always wonder what's going on, whether it is the plant is behind again on getting up to full speed, or whether there was some sort of M&A that went wrong and there's a disagreement in terms of the future of the company. It certainly doesn't help your confidence in this type of a name.
Okay, thanks, Tom, for that question. And to Elliot in Hamilton, the date of the Franco-Nevada Annual General Meeting is May the 1st this year. May 1 this year is the date of that AGM. Phil is in Ottawa, and he's our next caller. Hi, Phil.
Yeah, hi, guys. I only want to pick one dividend-paying oil and gas stock to hold, say, for 5 years. And I'm leaning towards CNQ, but I'm also looking at Suncor. So I'm just wondering what your opinion is on those two, or if there's something I'm missing, if there's another one out there. Okay, thanks a lot.
Thanks for the question, Phil. Yeah, you certainly started with, what is certainly considered one of the cream of the crops in terms of senior producers in Canada. Suncor is making good strides over the last year, after kind of a dismal few years of operational execution, safety issues, a lot of questions about culture. None of those things you hear with CNQ. It's just so consistent. Doesn't mean they're infallible, but just a great management team, solid balance sheet. They just reached their target, which means that their free cash flow payout will now go to 100%. From, I think it was 75 or 50% prior to that. So we'll see good dividend growth. They just announced a 5% increase. I think it's yielding around 4.5 or 4.6%. Can't beat that. I think you just got to stick with who has been the most consistent. It is not always the cheapest, but I think it's a well-deserved premium. And again, if you're looking at a 5-year horizon, I see consistent growth. I know they've grown their dividend. I think it's 30 years every year. So you'll continue to see the same thing, especially in an oil environment where we envision $80 plus over that time horizon as, again, the world continues to see that oil is an important part of the energy spectrum.
Okay, thanks for that question. Let's go to Leamington, Ontario, where Ron is on the line. Hi, Ron.
Hi, thanks to both of you for taking my call. I bought HLIT, the Horizons Lithium ETF, at $47 to capitalize on the increased demand for lithium. And I thought that was a bit high at the time, and I heard about some hype selling or buying that might have occurred. But I've seen it now go down under $20 with some recovery recently, and would really appreciate an opinion as to whether or not there's some scope for further recovery or if it will just continue to suffer. Thanks.
You were right. It was too high at 47,000. And look, we've seen this. I alluded to it in the previous question about energy transition. And the reality is it doesn't come that quickly. There's a lot of turmoil that happens in that process. So the traditional ones like oil and natural gas, and probably more natural gas as a transitional fuel, aren't going anywhere soon. And lithium, yes, it is part of the equation. Copper is part of the equation. Nickel is part of the equation. But the reality is it isn't that there is a lack of lithium. There's plenty of lithium in the world. It is plentiful. It's just a matter of how quickly can we bring it to market. And I think people were surprised how quickly we could expand existing projects, especially in South America, with brine solution mines, especially in places like Chile and Argentina. I think that kind of caught the market off guard. And then you throw in the demand dynamic, which was people weren't gravitating towards electric vehicles as quick as perhaps the market had envisioned. There has been what I'll call a demand shock with respect to that transition. It will happen. There's no doubt about that. We're not debating whether energy transition comes. I think it's just the velocity and what are the pieces of that puzzle and how do they fit in over the next 10 to 20 and 30 years. So I would say you're probably close to that bottom. I don't envision there's 20% downside from where you are, and I could envision 50% upside. So I think the risk reward is quite attractive at this point. We obviously don't buy the ETF on our funds, but we own names like SQM or Albemarle would be kind of our big cap ways of playing the upside for lithium over the near-term future.
Okay, thanks for that call. Greg is in Almont, Ontario. Hi, Greg.
Yeah, good afternoon, Paul and Dennis. Thank you for taking my call. Dennis, I was encouraged to hear you're bullish on the energy sector, and particularly mentioned MEG and Cenovus, which I'm invested in and pleased with. But I wanted to turn my attention to one of the pipelines, Enbridge. I do hold Enbridge. I'm a little underwater, not much. And currently it's trading a little bit below mid-range of their high and low for 52 weeks. And I was wondering, would you be, I want to average down a bit, would you be buying now or would you wait for maybe a slight pullback? Thank you again for taking the call.
Thanks, Greg. I'm always reticent to say, hey, let's try and time this. When you're talking about a name that has been in business so long, it is such a core part of Canada's infrastructure. I wouldn't necessarily say, 47 and a bit is going to be, a low for the next year. It might go lower than that. All I'm going to say is, like our caller earlier on C&Q, if you're looking for something to hold for 5 years as a sustainable dividend, 30-plus years of dividend growth, and you're looking for a less leveraged way to play energy, kind of sleep better at night than owning the C&Q, Cenovuses, or the MEGs of the world, Enbridge is the way to do that. We have such confidence in this company that we actually created a fund just around Enbridge called eSplit, and it's to give our unit holders the opportunity to have what I'll call beta to Enbridge, as well as you can even own preferreds if you want to take less risk and still get the nice dividends. So that fund is over 400 million in size, and it kind of tells you how much confidence we have that Enbridge is a great thing to own if you want to participate in energy, in particular around energy infrastructure. And I think more uniquely to Enbridge, say over TransCanada or TA, is that it is really more ingrained in energy transition because of its exposure to natural gas and where it can move that natural gas within North America and go globally. So that's why I think we're really confident that Enbridge is kind of that great 5-year thing to hold if you want, in particular, energy infrastructure in your portfolio. You
referred to TransCanada, you mean TC Energy, correct?
TC,
as
yeah.
the potential alternative to Enbridge, and you prefer Enbridge to TC Energy?
We certainly prefer Enbridge. We see TC with a little more risk on its growth profile being in Mexico versus Enbridge being more North American focused, kind of a nice balance between gas and oil, and now bringing up the utility growth with this acquisition in the U.S. that we expect will close. And that, again, kind of puts more of a ballast in the ship.
Now for past picks, Dennis De Silva visited with us on November 15th, 2023, not that long ago. His first pick on that day was MEG Energy, or the first top pick on that day, MEG Energy, ticker symbol, of course, MEG on the TSX. Recommended when the stock was trading at 26.74, now trading at 29 plus. I actually see it on my live screen here at 28.75 at this moment. That is a return at the $29 price target or the $29 price, a return of 9% and a total return also of 9%. Dennis.
We continue to own MEG. I consider it one of the best ways to participate in this TMX differential revaluation trade. It's been one of the best performers year to date in the energy sector in Canada, for sure. This is, a smaller cap, intermediate producer, 110,000 BOE a day of heavy oil, certainly scalable. There's always debate about this being taken over, whether it's Suncor, possibly even a U.S. company looking for long life, low decline assets. MEG would be certainly one way to participate in that kind of a trade. So we'll continue to own it. We think there's probably 25 to 30% upside as it revalues to be more consistent with larger cap heavy oil producers.
Okay. Number 2 on that day, also a very familiar name to Canadian resource investors, Teck Resources, the publicly traded mining giant, recommended at 48.72 not that long ago, November 15th of last year, now at 53.67. That's a return and total return of 10%.
Yeah, I certainly would have liked a better return. We continue to own Teck in some of our portfolios. I think the last time I was on, we had just gone through the ordeal of selling Elk Valley, their coal asset, and so that's about to close. I think they did the initial transaction, which significantly reduced debt, and I think as they close, I think it's Q3 of this year, it will essentially make them debt-free and have probably a couple of $1 billion of cash, and that will be very important in terms of driving some of their future growth to finance some of their new projects and expansion. So it's a name we continue to like for its copper exposure. QB2, which is their big copper project, continues to ramp up, and I think that's going to drive copper production growth of about 50% by 2025. So it is one of those unique large cap, higher growth companies in the Canadian space, and kind of the copper champion. I think, especially with First Quantum having its issues with Panama, Teck really takes the mantle as the copper champion in Canada.
Okay. Finally, Denison Mines in the uranium space, DML on the Toronto Stock Exchange. You can see the numbers there. A return over that period of time of 13%, a total return also of 13%. Dennis?
We are not in that position currently. We kind of took an opportunity with, uranium breaking $100 a pound. We did take some money off the table. It was up 50% for us over a few months. It doesn't mean I won't go back into it. Uranium's taking a bit of a breather now that it's below $100 a pound. I look to get back into it probably in the second quarter. The story remains the same. This is going to become the first in situ leach recovery project in Canada. It's unique, not unique for the US or Kazakhstan, but certainly unique in Canada. Well financed. I think they have, right now they own ounces or pounds of uranium that they bought in the open market over the last few years, and it's worth about $275 million. Certainly a financeable project for this company. Look forward to more details on the financing package, but this will be the first in situ recovery project in Canada in the next 5 years.
In situ is mining without digging a hole, essentially, correct?
Correct. You don't get that big, ugly footprint. Right. Now, in terms of uranium in Canada, it tends to be underground, very complicated and unique in Canada. In this case, it's going to be, it's almost like oil wells. You're drilling and injecting certain mix of fluid to break down the uranium, and then you pump it back up and you separate it on the ground. But the footprint is really just buildings, processing buildings, rather than any moving of earth and stockpiles and things like that. Much cleaner.
That's Dennis De Silva and his 3 top picks when he visited with us in November of last year. They were Meg Energy, Teck Resources, and Denison Mines. You can see the total return, 11% over that period of time. Dave is in Toronto, and he's our next caller. Dave, thanks for calling.
Oh, hi. I'd like your comments on Vermilion Energy, VET.
Thanks, Dave.
Thanks, Dave. Yeah, Vermilion is one of those unique entities in the Canadian energy space where it is an international player, production in Europe and Australia as well as Canada. You know, it used to be one of those things where they gave you a nice margin exposure to, say, Brent oil or European gas compared to its Canadian counterparts. But more recently, it's kind of been hit hard by a lot of the turmoil in European gas, you know, the windfall taxes, some of the production interruptions that they've experienced. So it's been a relative underperformer. Still has a pretty nice yield. I think it's just under 3%, but certainly not competitive with its Canadian traditional counterparts. I think they've tried to kind of reestablish their Canadian base in the Montney. They have a creeping takeover. I think they're 21% of another energy company, a junior in Canada, probably to, again, bolster their exposure in that play. I think 60% of their capital budget for 2024 will be in the Canadian Montney project. So I think they're kind of trying to reposition after stumping their toe a few times in the European as well as international arena. That worked for a while, but I think now people are finding there's better valuations in the Canadian or even U.S. space compared to some of these, what I'll call conglomerate, North American, European types of companies, of which Vermilion is one of those unique ones. So we don't own it currently. The yield doesn't compete with some of our favorite names that we'll probably talk about later in the show.
Okay, let's go to the email inbox. Marg is our email writer this time around. Good morning. Could I please get your guest opinion of Baytex and its future prognosis? Thank you, Margaret. Thanks, Margaret.
So, Margaret, we don't own Baytex. It's not what I call one of our top 10 names. They had a rough quarter last week. They were down. Again, one of those unique names that were down, even though a lot of other companies were up on their quarterly results and outlook for 24. I think they continue to kind of struggle a bit with their repositioning into higher margin, higher quality plays while managing with their debt. So it's one of those names like Vermilion we've kind of shied away from because it lacks some of the consistency we look for in terms of not only strategy, but also kind of margin durability when prices do come off. These are a little bit higher beta names from our perspective, so we stay away from them.
Okay, thanks, Margaret. Teferi is our next caller. Teferi is calling from Vancouver. Hi, Teferi.
Hi, good morning. I would like to get Dennis's opinion on D2 Gold and is dividend sustainable, please?
Yeah, it's certainly sustainable. I think it's around 4%. It's a unique intermediate, around 1 million ounces is the gold producer that can still grow high single digits, low double digits. Nicely diversified from our perspective. The next big leg of production growth comes from the Sabine asset that they bought last year. We were a shareholder and we took B2 Gold stock quite happily. It's caught up again in this gold malaise like everybody else has, perhaps a little more because it's not a large cap like an Agnico or a Kinross or a Newmont and so forth. But I think it has much better leverage to the upside in gold at this point. And you could kind of see its performance today is kind of in line with the group. But I think there's, some risk to execution. We're talking about a project in northern Canada where it always is subject to severe temperatures. Can you move materials around when there are opportunities, even though they have an all-weather road now? I think there's the usual, is it going to be on time and on budget? We've already seen CapEx expand even after the acquisition. But they are fully financed for this. They don't need to raise more equity. Very solid balance sheet. So we own it currently, and we'll continue to own it and add to it opportunistically with this gold run.
Okay. Thanks for that question, Teferi. Let's go to Edmonton, Alberta, where Paul is on the line. Hi, Paul.
Hello. I have a question about Suncor. I understand Suncor's base plan, the ore body for the base plan only has 9 or 10 years left in it. And I'm wondering how serious this issue is for a long-term investor. Also, if a person was going to sell their Suncor, when would you recommend selling it?
I think I alluded to it earlier about C&Q versus, say, Suncor, and C&Q has always been our go-to, even though Suncor has made significant improvements in terms of its safety track record, consistency on a quarterly basis of results, and I think culture improvements, which is more important. And you could see that in the way the stock has performed. Again, I continue to gravitate towards the C&Q. You're right about the base deposit has a shorter mine life, and that's always been a question mark for Suncor. And again, I said earlier, why a MEG would be a logical tuck-in for Suncor. It would be a way to kind of replace things in the next decade once they run out of ore from that base. There are other projects that they also have in the hamper, but I think buying 110,000 BOE a day of heavy oil with the ability to grow that at least a double in the next decade, I think would probably be good money spent. Certainly, as we're a little selfish because we own MEG and not Suncor at this point to the same degree. But again, C&Q would be my first pick if I'm looking for that kind of heavy oil exposure. MEG would be a drop down in terms of size, but I think gives you much better leverage to not only differential improvements, but also M&A would be a small part of that equation in terms of upside.
Okay, thanks, Paul in Edmonton, for that question. Yannick is in Toronto. Hi, Yannick.
Hi, how are you? Thank you for having me on your show. I have a question about Tamarack Valley. And I see they pay a fair amount the debt. And I'd like to know if you think we have a chance we have cash back to a cash flow this year. Thank you so much. Have a great day.
Thank you.
Thanks, Yannick. Yeah, Tamarack Valley is a name of full disclosure. We do own it currently, probably be adding to it. What we like about it is it has a pretty nice yield. I think it's 4.5 and change. It's, what's particularly appealing about it, and then I'll go to some of the issues it faces, is about half its production comes from the Clearwater Formation, which is kind of the hottest play in Canada. And one of my top picks is focused exclusively on the Clearwater. Very high margin, excellent leverage to, again, differentials pulling back to perhaps more historical averages or even tighter than that as TMX comes online and we have more egress in Canada. One of the important things the market is looking for, besides continued improvements with well productivity, is the fact that they went kind of through an acquisition binge that kind of hurt the stock because people didn't like how many they were doing and some of the unique royalty deals they were doing and streaming deals, I should say, with one of our favorite names, Topaz, for example. So they're expected to reach a target for their debt in the second half of this year, and that will kind of open the door to go from 25% of free cash flow to return of capital for shareholders to, I believe it's 50% in the second half of this year once they reach that target. It will ultimately climb to 75% against once the next target gets reached. So there's good leverage to oil. It's in one of the hottest plays in Canada. We're looking for progression on this debt reduction, which opens the door to more formal return of shareholder capital provisions through both their base dividend as well as what I might consider buybacks in the future.
Okay, thanks, Yannick, for your question. Alex is in Niagara Falls, Ontario. Hi, Alex.
Hello. Thank you for having me. My question is about Agnico Eagle. Do you see it in the $75 range within the next year if gold stays above 2,000? And do you think it could be a takeover target? Thank you.
Wow, Alex, a takeover target, not what I would think for Agnico Eagle. So Agnico is, you know, again, still one of the cream of the crop senior gold producers in Canada. It is over time through acquisitions like the partial acquisition of Yamana with Pan American, as well as buying Detour in that mix, and Kirkland Lake has consolidated firmly its base being in Canada. I think 90% of net asset value is in Canada, and it owns the two biggest mines in Canada, being Detour and Osisko. And so at this point, I think this is a core holding. If you're, again, looking at a 5-year horizon, dividend growth will be coming. I think there's fantastic leverage to gold moving, and I think that target that you gave me, $75 is easily achievable given where it is today. I think this is more a matter of, is this an $80 or $90 stock if gold, for example, were to go in the midterm to $2,500 or $2,400 gold? Because I mentioned earlier, you know, inflation has started to come off, like we've seen with many other sectors. So that sort of ugly part of the business is starting to dissipate, and we'll see margin expansion even without gold moving up. So you can imagine what happens if gold's at $2,300 or $2,400 US. You're talking about a company that could achieve probably $1,200 to $1,300 all-in sustaining costs. You're talking about double that in terms of where the gold price is. So very good margins, solid balance sheet. And I wouldn't consider it an M&A candidate in terms of being acquired, but certainly could be the acquirer, as we still see, you know, small cap companies with pretty good projects struggle to find capital, and they might be opportunistic in that, as we've seen in the past.
Thanks for that question. Let's go to Terry in Surrey, BC. Hi, Terry.
Hello there. Thanks for taking my call. My question's on freehold royalties today. In their last announcement here, or their quarter or the year end, they have a good dividend. They've added to their reserves over last year, and I just was wondering, at current levels, is it a buy or hold? And if you own it, would you be buying right now?
I don't own it currently. I think one of my colleagues, Rob Lozon, might still own it. It has a very attractive yield. I think it's around 8%. It has morphed over the years to being more focused in the U.S. I think 40% of its activity, or 40% of its net asset value, is now in the U.S., but probably 80% of its activity going forward will trend towards the U.S. and the Permian, which is obviously the most popular play in the U.S. They also have exposure to the Clearwater in Canada, so they kind of have their feet in two very good places, both south of the border and here in Canada. I think the last week when they announced their quarter, there was a little bit of disappointment with respect to their growth. I think we're looking at 3% growth in their U.S. assets and flat in Canada. Probably a little less activity than people anticipated. I think that will probably change a little more on the U.S. side. I think that could creep up as we see more drilling activity in the U.S., perhaps on a year-over-year basis, than in Canada, where we've always been a little more conservative with respect to our activity. Even with TMX coming on, I think we have a pretty good idea that that's going to get filled up with the growth that is kind of behind pipe right now in Canada. So it hasn't been our go-to name. We've kind of always looked at it as opportunistic because of the big discount it has to some of the other royalty players in Canada. But, you know, nice dividend. There's no real downside risk outside of energy exposure risk. So I think you could sleep well at night in terms of if you own it currently. I think there just might be some better opportunities to own the EMPs right now, or own some hybrids, like I said earlier, at Topaz, which is a little bit of infrastructure as well as royalties, to kind of give you that base support from the infrastructure and some of the upside from doing new royalties, especially here in Canada.
Dennis De Silva's top picks. Number one on this day is Headwater Exploration, ticker symbol HWX on the TSX. Dennis?
I probably alluded to this earlier in terms of it's a small cap, clear water oil player. So again, hottest play in Canada. We've owned this across a number of portfolios. Great exposure to, again, differentials shrinking as TMX comes on full bore in the second half of this year. This is that rare combination of growth, dividend, which they initiated in 2023. It's, I think, around a 6% yield. It will grow somewhere between 10 to 15% this year. Its 5-year plan, which they initiated last year, it will grow by 50% over where it was in 2023. So quite significant growth, a nice sustainable yield, still significant free cash flow over and above that base yield that they could use to finance expansion of their properties so that they can continue to grow beyond 2028. There's some pretty interesting exploration in this name as they continue to accumulate lands, and they need to explore some of these more fringe areas. But so far, the results have been fantastic, and we're very happy shareholders, and we'll look forward to, again, the dividend growing, continued expansion of their land base, the growth being realized, which is unique in the oil patch, this kind of growth, and probably will be acquired well before 2028.
Okay, interesting. Tourmaline Oil, ticker symbol TOU on the TSX, is top pick number 2. Dennis.
This is the largest natural gas producer, despite being called Tourmaline Oil, largest natural gas producer in Canada. You know, it is cream of the crop. I've talked about this ad nauseum many times before. CEO was just voted CEO of the year by Financial Post. Mike Rose is the CEO, doesn't take a salary. Again, one of those unique situations, owns so much stock, has been a big shareholder, probably the biggest since the company was started, and we have followed him through his previous progressions that always end with a takeout by large cap or senior producers. In this case, we see Tourmaline as, you know, this is, I think, a very unique opportunity from a timing perspective. I never like to get into timing a stock, but when you look at this one compared to some of its peers, like an ARC, which we own also, it has been an underperformer for the last few months. I'll take some of that as weakness in gas prices. In particular, we hit, I think, a multi-decade low in February. So I think this is opportunistic to buy now for that low-cost base, significant dividend in terms of a nice base, but significant special dividends that we anticipate will come every quarter. At least that track record has been established. And a nice high single-digit growth rate. And when you combine it with specials, you're looking at mid-teens, probably 15 to 17% total return without gas doing much more than what it has now, which is bounced back from its bottoms in February.
Okay, we've got about 60 seconds left for Capstone Copper, ticker symbol CS on the TSX.
This is a top copper growth story. We do own it currently in a number of portfolios. It's in South America as well as in Mexico. This is going to go through a re-rate as its newest project comes on to production. And we see significant upside, you know, probably 20 to 30% without copper going materially higher. I know we're not too far off record highs for copper, but this is one of the better ways, I think, to get exposure. I mentioned, of course, Teck is kind of the champion in Canada. This would be, if you want to go into kind of that mid-tier, this is one of the better ways to get exposure to copper because of that growth.